Disclaimer.
Hi, it's AG. New look, new laptop, but always focused on the market. Now that the introductions are done, listen to the rest. Most traders are staring at the silver chart right now trying to find a bottom. They're wrong. On January 30th, silver didn't just correct, it hit a mechanical wall. We went from an all-time high of $121.64 to a total liquidation event in under 24 hours. If you think this was just profit-taking on the Kevin Warsh nomination, you've already missed the real story. While the headlines focus on Fed politics, the CME Group just executed a 36% hike in maintenance margins, taking silver from 11% to 15%. Effective as of yesterday, is close February 2nd. This is the margin cascade. It doesn't care about your bullish thesis or the solar deficit. It's a forced exit for every over-leveraged account on the planet. As we sit here on February 3rd with silver fighting for $86, the question isn't, is it cheap? It's who is left to sell. Today, I'm stripping away the noise. I'm showing you the LBMA vault data proving physical stocks remain structurally tight. The truth behind Bank of America's $60 fundamental warning and the one Fibonacci level at $71.20 that is currently holding the entire bull market together. 99% of traders are gambling on a bounce. We're going to map the probabilities. Let's look at the data. Here's what that $121 peak really was. A narrative trap with perfect bait. Think about the setup leading into late January. Donald Trump publicly threatening to fire Jerome Powell, nominating critics of central bank independence to the Federal Reserve Board, the dollar index hitting 4-year lows, and China reportedly buying silver hand over fist while restricting exports. Every single ingredient pointed to one conclusion. Endless money printing, currency debasement, precious metals to the moon. The only problem? The narrative flipped in less than 12 hours. When news broke that Trump had officially nominated Kevin Warsh as the next Fed chair, everything changed. If you don't know Warsh, here's what matters. He's a known hawk who advocates for a smaller Fed balance sheet and tighter monetary conditions, the exact opposite of what silver bulls were betting on. Within minutes, the dollar index reversed sharply. Within hours, silver was in free fall. By the time New York closed, the metal had plunged 26.7%, marking the sharpest single-day collapse since the Hunt Brothers Silver Corner imploded in 1980. But a 27% drop alone doesn't explain what we're seeing today. Markets crash all the time. What turned this painful correction into a systematic liquidation event was the machinery that activated behind the scenes at the Chicago Mercantile Exchange. Let me explain how CME margins actually work, because this is the part your broker probably didn't tell you. When you buy a silver futures contract, you don't pay the full value up front. You post what's called a performance bond, basically a good faith deposit that covers potential losses. For years, that margin was set as a fixed dollar amount per contract. If silver was at $30 or $80, the margin might stay relatively stable because CME adjusted it manually based on volatility. But in January 2026, CME made a quiet but massive change. They switched from fixed dollar margins to percentage-based margins tied directly to the value of the underlying contract. According to CME Group's official notice issued on January 30th, this new system took effect after the close of trading on Monday, February 2nd. Think about what that means in practice. When silver was at $30 per ounce, an 11% margin on a 5,000-ounce contract meant you needed about $16,500 in your account. Uncomfortable, but manageable for serious traders. When silver hit $121, that same 11% margin required $66,550 per contract. Then, CME raised it to 15%. Now you need $90,750 per contract just to hold your position. Pop quiz. What happens when the price crashes 27% in one day and your margin requirement simultaneously increases by 36%? You get margin calls, lots of them. Traders who thought they had adequate capital suddenly found themselves forced to either deposit tens of thousands of dollars immediately or liquidate positions at the worst possible time. This is what we call a margin cascade. It's a self-reinforcing death spiral, where falling prices trigger margin calls, which force selling, which drives prices lower, which triggers more margin calls. The CME's new percentage-based system didn't just respond to volatility, it weaponized it. Every dollar silver dropped made the margin requirements slightly more achievable in absolute terms, but the speed of the collapse meant accounts were getting liquidated faster than traders could wire money to their brokers. And here's the kicker. This wasn't some temporary panic that resolved itself by Friday afternoon. This forced liquidation cycle is still active right now. Anyone still holding leveraged silver positions woke up this morning needing to post significantly more capital or face automatic liquidation. Let me put this in perspective with a real scenario. Imagine you bought 10 silver contracts back in December when the metal was trading around $82. That's 50,000 ounces of silver, and at 11% margin, you needed roughly $45,000 in your account. Aggressive, but doable. You rode the wave up to $121, watching your position gain nearly $200,000 in paper profits. You're thinking about early retirement. Then January 30th happens. Silver crashes to $85. Your $200,000 gain evaporates to about $15,000. Painful, but you're still slightly ahead. You decide to hold because fundamentals haven't changed, right? Physical market is still tight, dollar could weaken again, Fed might cave to political pressure. Then you check your account Monday morning, February 3rd. Your broker sends you a notice. Margin requirement per contract just increased to $63,750. For 10 contracts, you now need $637,500. You currently have about $60,000 in your account after the drawdown. You're short $577,500, and you have until the end of the trading day to wire it, or your positions get liquidated automatically at whatever price the market decides. That's not a hypothetical. That's the math thousands of traders face this week. Now, the natural question is, why would CME do this? The official explanation is always the same. Normal review of market volatility to ensure adequate collateral coverage. And technically, that's true. Exchanges have a responsibility to prevent defaults that could threaten the clearing system. When prices swing violently, margin requirements need to increase to protect the integrity of the market. But here's what the official explanation doesn't tell you. The timing of this margin increase wasn't random. CME didn't wake up on January 30th and spontaneously decide to overhaul their entire margin calculation methodology. This change was planned, announced, and implemented with perfect precision at the exact moment maximum damage would occur to long positions. Whether that was intentional market manipulation or just unfortunate timing for the bulls, the effect is identical. Anyone using leverage to play the silver rally just got systematically crushed. And we're not talking about retail gamblers who bought 10 contracts on their credit card. According to data from the Shanghai Futures Exchange covering January 30th through February 2nd, Chinese speculators, who had been among the most aggressive buyers during the rally, saw a record reduction in open interest as domestic accounts unwound positions en masse. Why? Because China's export licensing fears combined with the Warsh shock created a perfect storm of political risk and technical breakdown. When you're a Shanghai-based trader and your government might restrict silver exports while the US Fed nominee is signaling tighter money, you don't wait around to see what happens next. You sell. So now we're in this position. The fast money's gone, the narrative has flipped, the margin spiral is still in effect. And if you're one of the traders still holding positions, you're fighting against a deleveraging wave that has nothing to do with silver's fundamental value and everything to do with mechanical market structure. Here's what you need to understand. The people who made fortunes on this move weren't the ones predicting $150 silver. They were the ones who understood the margin mechanics, recognized the narrative trap at 121, and got out before the machine turned against them. The charts were screaming warning signs for anyone who knew how to read the language of institutional positioning and exchange-level risk management. The question for the next 90 days isn't whether silver will recover to 121. The question is whether you can survive the 15% margin requirement long enough to see whatever comes next. Because right now, success in the silver market isn't about being bullish or bearish. It's about understanding that you're not trading against other investors anymore. You're trading against a margin calculation that's designed to flush out everyone who does not have fortress-level capital backing their positions. And if you think the worst is over, just because we've bounced from the Friday lows, you haven't been paying attention to what's coming next. Now let's talk about the disconnect that nobody's addressing. While futures traders were getting wiped out by margin calls, something fascinating was happening in the physical market. Or more accurately, something wasn't happening. When silver crashed from $121 to the low 80s in 30 hours, you'd expect one thing to follow: panic selling of physical metal, retail investors dumping their coins in bars, vaults flooding with metal as people rushed to lock in whatever gains they had left, industrial users canceling orders because suddenly silver got cheap again. The entire physical supply chain should have loosened up immediately. That's not what the data shows. According to the London Bullion Market Association's most recent published figures from December 2025, London vaults held 27,818 tons of silver. Now, before you say that sounds like a lot of metal, let me give you context. During the COVID market disruptions in April 2020, those same vaults peaked at 35,667 tons. We're talking about a 22% decline from that high. And more importantly, we never recovered those inventory levels, despite silver rallying from under $30 to over $120. Think about what that means. Silver prices tripled, speculative mania reached levels not seen since 1980, Every futures trader and their cousin piled into paper contracts betting on higher prices. And yet physical inventory in London, the center of the global over-the-counter silver market, stayed structurally depressed. The metal that came into vaults during the rally wasn't nearly enough to offset what left during the same period. Here's where it gets interesting. In October 2025, London saw the largest single-month inflow in at least 9 years. 54 million ounces poured back into vaults as arbitrage traders took advantage of historic price dislocations between Shanghai, New York, and London. That massive inflow brought total holdings up from the July lows around 24,000 tons. But even with that record injection, we're still sitting well below the levels we saw when silver was half this price. What does that tell you? The physical tightness that drove the rally from $30 to $121 was not solved by higher prices. It was temporarily masked by arbitrage flows and ETF liquidations. The Silver Institute has documented 5 consecutive years of supply shortfalls where industrial demand, investment demand, and jewelry fabrication combined exceeded mine production plus recycling. 5 years. That doesn't reverse overnight just because futures prices crash. Now, here's the part that should make you pause. While everyone's watching the LBMA numbers, there's another inventory story playing out that got completely overshadowed by the price action. COMEX warehouse data for January showed a drawdown of 33.45 million ounces. That's roughly 26% of registered inventory disappearing in a single month, not transferred from registered to eligible. Gone. Physically delivered and removed from the warehouse system entirely. You want to know what that looks like in practice? Picture this. Silver is trading at $110, $115, $120 in mid-January. Futures speculators are piling in, chasing momentum, betting on $150. At the exact same time, industrial users and large physical buyers are standing for delivery, taking metal off the exchange at prices they know are unsustainable. They're not buying paper. They're pulling actual bars out of the warehouse system, while speculators are trading IOUs against each other. That's the divergence between paper and physical. The futures market went parabolic based on narrative and leverage. The physical market stayed tight because real end users understood something fundamental. Regardless of where paper prices go, the metal itself remains scarce. Solar panel manufacturers don't care if silver touched 121 for 3 days. They care whether they can secure supply for production runs 6 months from now. And judging by withdrawal patterns, they're not taking any chances. This brings us to Bank of America. On January 26th, just 3 days before the peak, Michael Widmer, their head of metals research, published a note that most traders ignored because they were too busy counting paper profits. Widmer stated that while he expected silver to potentially reach $135 to $309 under extreme scenarios driven by gold-silver ratio compression, the fundamentally justified industrial price for silver was around $60 per ounce. Let me break down what fundamentally justified actually means in this context. Widmer wasn't making a price prediction. He was calculating what silver's industrial value should be based purely on supply-demand dynamics in sectors like solar, electronics, and electric vehicles, stripping out all speculative premium, all safe haven demand, all monetary debasement concerns, just raw industrial economics. $60. That's where industrial demand intersects with mining costs and recycling economics to create equilibrium. Everything above $60 represents some combination of investment demand, speculation, or monetary concerns about fiat currency. When silver hit 121, roughly half that price was speculative premium stacked on top of legitimate industrial value. Now we're sitting at $86. Do the math. We're still $26 above what Bank of America considers fundamentally justified. That's a 43% premium to industrial value. Is that premium warranted? Maybe. If you believe central banks will keep expanding balance sheets, if you think the dollar's role as reserve currency continues eroding, if you expect solar installations to accelerate beyond current projections, then yeah, a premium to pure industrial value makes sense. But here's the trap. That premium can evaporate faster than it accumulated. The move from 60 to 121 took months of building narrative, momentum, and positioning. The move from 121 to 86 took 30 hours. If we're still trading on borrowed narrative rather than industrial fundamentals, the next leg down won't be a gentle drift. It'll be another mechanical purge as remaining speculators realize the premium they're paying might not be justified. And that brings us to the technical level that everyone's watching, but nobody wants to talk about honestly. $71.20. This isn't some random number pulled from a crystal ball. It's the 50% Fibonacci retracement of the entire move from the breakout point in mid-2025 to the January 2026 peak. Fibonacci levels work in markets not because of mystical mathematical properties, but because institutional traders, algorithms, and technical analysts all use the same reference points. When enough market participants agree that a level matters, it becomes self-fulfilling. The $71 to $72 zone represents something deeper, though. It's not just a retracement level. It marks the approximate price where silver spent several weeks consolidating in late 2025 before the final parabolic surge into triple digits. That consolidation represented a temporary equilibrium where bulls and bears agreed on value. Below that level, there's not much support until you get down to the long-term moving averages in the mid-50s. Here's what keeps institutional desks up at night. If silver closes below $72 on a weekly basis, the technical structure of this entire bull market comes into question. That doesn't mean silver is going to zero. It means the narrative that drove prices from 30 to 121 gets invalidated. And we enter a new regime where the old playbook stops working. Traders who bought at $50, $60, $70, thinking they were getting in on a secular bull market, would suddenly be looking at losses or marginal gains after riding a massive roller coaster. And the pressure on that $71 level is building every single day we stay in this range. Look at the positioning data from the Commodity Futures Trading Commission. Managed money accounts that got long during the rally are being systematically forced out by margin requirements and stop losses. But here's the problem. They're not all getting out at 85 or 90. Many are waiting, hoping for a bounce back to their entry points before they exit. That creates a supply overhang. Every $2, silver rallies from here, you hit another layer of trapped longs looking to exit. Traders who bought at 88, 90, 92 during the crash are all waiting to get back to break even. That's not a conspiracy theory. That's basic market microstructure. Traders who are underwater wait for rallies to exit. Traders who are profitable add to positions on dips. Right now, we have way more of the former than the latter. So when you see silver bounce from 83 to 89 and everyone starts talking about recovery, what's really happening? Forced sellers take a breath. Short-term technical traders try to scalp a few points. Maybe some retail buyers think they're getting a bargain. But none of that changes the fundamental positioning problem. There's a massive amount of metal that needs to change hands before this market can establish a sustainable base. The LBMA data, the COMEX withdrawals, the Bank of America fundamental analysis, the technical levels, they're all telling the same story from different angles. The paper market went parabolic, detached from physical reality, and is now going through a violent repricing. The physical market stayed tight throughout the entire move because industrial demand never wavered. And the price zone, where paper volatility meets physical scarcity, that's somewhere between $60 and $75. Above that range, you need a new catalyst to justify higher prices. Below that range, physical buyers will step in aggressively because industrial economics make it compelling. We're stuck in the middle right now, and the leverage that drove us higher has turned into the anchor dragging us down. One more thing you need to understand about this moment. The usual playbook isn't working. Normally, when silver corrects hard, you get a reflexive bounce as value buyers step in. The bounce should have happened already. We are 4 trading days past the crash and still grinding sideways instead of reclaiming 95 or 100. That tells you the selling pressure is relentless. Every time silver tries to lift, another wave of forced liquidation or tactical exit hits the market. This is what distribution looks like in real time. Smart money that bought at 40 and 50 and 60 is using every bounce to exit. They made fortunes. They're not interested in holding through another leg down to find out if 71 holds. Retail money that bought at 90 and 100 and 110 is either already stopped out or paralyzed, hoping for salvation. New money is sitting on the sidelines waiting for clarity. Nobody wants to catch a falling knife while margin requirements are still elevated and the technical structure is deteriorating. The data doesn't lie. The structure doesn't lie. The behavior of physical versus paper markets doesn't lie. What lies is the narrative that this is just a normal, healthy correction before the next leg higher. If that were true, we'd already be back above 95 with strong volume and conviction. Instead, we're stuck in the mid-80s with weak volume and zero conviction, while the margin spiral continues grinding accounts into dust. So where does that leave us? The proof is in the numbers. Physical markets remain structurally tight, but can't support $120 paper prices without massive speculative premium. Bank of America says fundamental value is 60. Technical analysis says 71 is the line that determines whether this bull market survives. And market structure says we're in a forced liquidation cycle that won't end until either margin requirements come down or prices fall far enough that buyers with actual capital show up. The next section is going to walk through the probabilities, the targets, and most importantly, the timeline for how this plays out over the next 90 days. Because understanding the proof is one thing. Trading the reality is something else entirely. Let's get mathematical about what happens next. Not predictions, probabilities, not hope. Calculations based on how leveraged markets behave when they're structurally broken. First thing you need to understand, we're likely heading into what traders call a dead cat bounce. The term is brutal but accurate. When an asset falls violently from extreme heights, Physics and psychology combine to create a reflexive rally that traps the last wave of hopeful buyers before the real damage begins. It's not a reversal. It's the market's way of resetting positioning before the next phase. Here's how to calculate where that bounce targets. Take the crash low of $77 hit during the Asian session on February 2nd. Take the current resistance zone, where selling pressure consistently overwhelms buyers. That zone sits between $90 and $95. Every time silver has tested 90 since the crash, it gets rejected. Not because 90 is expensive in fundamental terms, because 90 represents where thousands of traders who bought during the final surge are sitting with underwater positions, waiting desperately for a chance to exit at break-even. The mathematical sweet spot for a dead cat bounce sits right in that $90 to $94 range. Why? Because it's high enough to trigger short covering from bears who got aggressively short during the crash. It's high enough to create FOMO among retail traders who think the bottom is in. And most importantly, it's exactly where institutional sellers want to distribute the last of their positions before stepping away entirely. Think about the psychology. You bought silver at $92 in mid-January. You watched it run to $121. You were up 30% in 2 weeks. Then the crash hit. Now you're down 7%, bleeding slowly. Every day we grind lower. Silver bounces to 93. You're almost break even. You don't even think. You hit the sell button and walk away, grateful to escape with your capital intact. Multiply that decision across thousands of accounts, and you get a supply wall that's mathematically insurmountable without a fundamental catalyst. The setup for this bounce is already forming. Look at the sentiment indicators. The put-call ratio on silver options spiked to extreme fear levels. Retail sentiment surveys show capitulation. Volatility metrics have compressed from the panic highs. These are the technical ingredients that precede short-term bounces. But here's the trap. Bounces in broken markets don't lead to new highs. They lead to better exit points for anyone smart enough to use them. If silver makes it to 90 or 94 over the next week or two, that's not the start of recovery. That's your last clear chance to reduce exposure or exit positions before the next leg down tests the real support levels. Because below the current range, there's a mathematical void where very few traders have positioned themselves. The zone between $75 and $85, that's where leveraged longs accumulated during the final melt-up. Below 75, the positioning changes entirely. Now let's talk about what happens if 71 doesn't hold. This is the scenario nobody wants to discuss, but everyone needs to prepare for mentally. The $71 to $72 zone isn't just a Fibonacci level or a technical reference point. It's the last line of defense for the entire narrative that drove silver from $30 to triple digits. Below 71, the story changes completely. When major support breaks in leverage markets, the initial move is usually violent. Not because fundamentals suddenly changed, but because every stop-loss order, every risk management algorithm, every technical trader watching the same charts executes the same decision simultaneously. Sell. The first 30 minutes after 71 breaks could see silver drop $5 to $8 on heavy volume as programmatic selling overwhelms the bid. That's not speculation. That's how markets with concentrated technical focus behave when key levels fail. Where does that selling exhaust itself? History and mathematics point to the same zone, $50 to $55 per ounce. Before you dismiss that as impossible, remember that just 6 weeks ago, most traders would have laughed if you told them silver would crash from 121 to the low 80s in 30 hours. Markets don't care about what seems possible. They care about where supply and demand reach equilibrium. The $50 to $55 range represents multiple converging factors. It's where silver was trading before the final vertical phase of the rally began. It's where long-term moving averages provide structural support. It's approximately where mining costs intersect with recycled supply economics. And critically, it's close to Bank of America's $60 fundamental value estimate, meaning industrial buyers would step in aggressively at those levels because the price-to-value proposition becomes compelling regardless of narrative. But here's what that move would actually mean for your portfolio. If you're holding physical silver, a drop to 55 is painful but survivable. Your ounces don't expire. You're not getting margin calls. You can wait for the next cycle. If you're holding futures contracts, mining stocks, or leveraged ETFs, a move to 55 is a complete reset that forces you to start over from scratch. Your capital doesn't survive that kind of drawdown when you're using borrowed money. Let's run the numbers on what it actually costs to survive this market right now. A single silver futures contract controls 5,000 ounces. At current prices around $86, that's $430,000 of notional exposure. Under the new 15% margin requirement, you need $64,500 posted per contract just to hold the position, not to open it, just to keep it from being liquidated. Let's say you're holding 5 contracts. That's $3,200,000 of exposure. Your margin requirement, $322,500. And that's assuming price stays stable. If silver drops another $5, your account is down $125,000 in mark-to-market losses, while your margin requirement stays elevated. Unless you're sitting on $500,000 in liquid capital, you're not surviving that scenario. The math doesn't work. This is the part where traditional silver bulls would tell you to buy physical and ignore the paper market. And look, there's wisdom in that approach if your timeline is measured in years and you're using cash you don't need. But let's be honest about the reality. Most people watching this video aren't sitting on $200,000 they can lock up in silver bars for the next 5 years. They're trying to trade the volatility, capture the momentum, and grow their capital in time frames measured in months, not decades. For those traders, February through April 2026 is a survival test, not an opportunity. The market structure is designed to flush you out. The margin requirements are designed to make leverage unaffordable. The volatility is designed to trigger your stops and force emotional decisions. Your job isn't to predict whether silver goes to 150 or 50. Your job is to not get destroyed by the machine while it sorts out where equilibrium actually lies. Here's the tactical reality. If you're still holding leveraged silver positions, you have 3 choices. Choice 1, post enough capital to survive a move to $65 or $70 without getting margin called. That means having twice your current margin requirement sitting in cash, ready to deploy. If you can't do that comfortably, you're gambling, not trading. Choice 2, reduce position size to a level where your capital can withstand a $20 move in either direction without forcing decisions. That probably means cutting your exposure by 50 to 75% from where you are right now. It feels like giving up. It's actually called risk management. Choice 3, exit entirely and wait for structural clarity. That means watching from the sidelines while the margin cascade runs its course, letting the dead cat bounce come and go. And only re-engaging when we see either a sustained break above 100 with healthy volume or a capitulation flush below 70 with industrial buyers stepping up. There's no shame in this choice. Sometimes the best trade is no trade. What you cannot do is hold your current positions, hope for the best, and assume the fundamentals will save you. The fundamentals might be right, the physical market might be tight, solar demand might be growing, central banks might keep printing. None of that matters if you get liquidated at $78 because you couldn't meet a margin call. You don't get to participate in the eventual recovery if you're not alive when it happens. Let me put this in perspective using historical context. In 2011, silver ran from $18 to $49 in less than 4 months. The rally was driven by similar narratives: currency debasement, physical shortages, investment demand. On May 2nd, 2011, silver crashed 11% in a single day. Over the next 3 weeks, it fell to $34. Traders who bought the dip thinking it was a gift got destroyed when silver continued dropping to 26 by the end of the year. The ones who survived, they either had no leverage or they recognized that parabolic rallies don't gently consolidate before resuming. They exhaust themselves, crash violently, then grind lower as the late buyers slowly capitulate. That process takes months, not weeks. We're currently in week 1 of what could be a 6-month reset. Here's what the next 90 days probably looks like if you force me to map probabilities. February sees choppy trading between $78 and $94. The dead cat bounce peaks somewhere in that 90 to 95 zone, gets rejected hard and rolls over. March tests the 71 to 72 support zone multiple times. Each test weakens it. By late March or early April, either buyers show up with conviction and we base build for a legitimate recovery, or 71 breaks and we get the flush to the 50s that resets positioning completely. Neither outcome is guaranteed. Both are mathematically probable based on how leveraged markets behave after parabolic rallies and violent corrections. Your job isn't to predict which path we take. Your job is to position yourself so that you survive either scenario without catastrophic losses. The final verdict for February 2026 comes down to a simple question. Are you trading silver, or is silver trading you? If you're making decisions based on hope, narrative, or what you think should happen, the market is in control. If you're making decisions based on capital requirements, margin mathematics, and probability-weighted scenarios, you're in control. Success right now isn't about catching the bottom or riding the next leg to $150. Success is having enough capital left when the smoke clears to participate in whatever comes next. That means respecting the 15% margin requirement that's forcing systematic liquidation. That means acknowledging the dead cat bounce for what it is, a tactical exit opportunity, not a reversal signal. And that means accepting that the $71 level is the actual line in the sand, not the fantasy number you wish would hold. The charts have revealed everything you need to know. The record peak was a narrative trap. The crash was mechanically amplified by margin changes. The current range is unstable because positioning is broken. The physical market stays tight but can't support triple-digit paper prices without speculation. And the path forward depends on whether institutional capital decides silver at $60 to $70 is compelling enough to fight the Fed, or whether we need to flush lower first to clear the deck. 99% of traders missed all of this because they were focused on predictions instead of probabilities, narrative instead of math, hope instead of structure. You now have the data, you understand the mechanics, you know the targets. What you do with that information determines whether you're part of the survivor cohort or part of the cautionary tale. The machine is running, the margin spiral continues, the dead cat is coming. And somewhere between here and $55, this market will find its footing. Your job is to make sure you're still standing when it does.